Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Diodes Incorporated annual report. Diodes Incorporated offers a wide range of businesses and services across various semiconductor markets. At the core of its operations are discrete semiconductor products, which include MOSFETs, CC MOSFETs, data line protection, power line protection, thyristors, and transient voltage suppressors. In addition to these products, the company provides analog products that cater to diverse applications such as power management devices, standard linear devices, LED lighting drivers, audio amplifiers, and sensor products. These include operational amplifiers, comparators, current monitors, voltage references, reset generators, Hall effect sensors, and motor drivers. The company also offers mixed-signal products, which comprise high-speed mux/demux, digital switches, interface redrivers, universal level shifters/voltage translators, clock ICS, and packet switches. Furthermore, it provides standard logic products, including low-voltage CMOS devices and advanced high-speed CMOS devices, as well as ultra-low power CMOS logic. In terms of services, Diodes Incorporated serves various markets through direct sales, marketing personnel, independent sales representatives, and distributors. Its customer base spans industrial, automotive, computing, communications, and consumer sectors. The company's extensive product portfolio and global reach make it a significant player in the semiconductor industry. The stock price of Diodes Inc. (DIOD) has seen a significant increase of 21.03% over the past year, primarily driven by robust financial results and optimistic guidance released in early 2026. The key event that triggered this surge was the announcement of the company's fourth quarter and full year 2025 financial results on February 10, 2026. Diodes reported a Q4 2025 EPS of $0.34, surpassing analyst estimates, and quarterly revenue rose 15.4% year-over-year to $391.58 million. The strong financial performance was further boosted by the company's guidance for the first quarter of 2026, which anticipated a 19% year-over-year increase in revenue. This announcement led to a 6.3% jump in Diodes shares in after-hours trading and a new 52-week high on February 10, 2026. Several strategic successes have contributed to Diodes' strong financial performance and positive outlook. The company has experienced significant growth in key markets such as computing, 25% increase, and automotive, 24% year-over-year increase. Additionally, Diodes has expanded its product offerings with over 650 new part numbers introduced in 2025, including 40% targeting the automotive market. The company's ambitious financial targets for 2028, aiming for $2 billion in annual revenue and $700 million in gross profit, have also instilled confidence among investors. These targets highlight Diodes' strong operating leverage and earnings potential, further contributing to its stock price increase. Diodes Incorporated market capitalization of $3 billion is materially smaller than most of its industry peers of roughly $36 billion. Diodes Incorporated trades at a higher price-to-earnings ratio of 45 times and a lower price-to-book ratio of 1.51 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The balance sheet appears very conservative, with liabilities representing only 22% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. Although shareholder equity has increased, the share count has risen while revenue is declining. This raises concerns that equity growth may be driven by dilution rather than business performance. The sustainability of the business model remains unproven. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline for a company can be attributed to several key factors. Firstly, changes in equity securities, hedge funds, liability-driven investments, and cash equivalents have significantly impacted the company's revenue. Additionally, regional variations in revenue performance have also played a crucial role, with Asia experiencing a notable increase in 2025 compared to 2023, while Europe and the Americas showed declines. Investments and acquisitions have also been significant drivers of revenue growth or decline. For instance, an increased investment in Atlas, Vi, and the acquisition of Forda Media, Inc., have contributed to the company's financial performance. Furthermore, customer-specific revenue data has highlighted specific trends, with Customer 1 and Customer 2 experiencing varying levels of growth. The net sales and gross profit metrics also provide valuable insights into the company's revenue growth or decline. A decrease in both metrics from 2023 to 2024 indicates a decline in revenue, which was offset by an increase in volumes in 2025. Overall, these factors have contributed to the company's financial performance over several years, highlighting the importance of regional and customer-specific trends in driving revenue growth or decline. The net income of the company underwent significant fluctuations between 2023 and 2025. In 2023, the net income was $230,648, which decreased by 78% in 2024 to $50,842. However, this trend reversed in 2025, with a 36% increase from $50,842 in 2024 to $69,170. The net income also saw an overall increase of 50.2% in 2025 compared to 2024, reaching $66.1 million. The profit margins of the company experienced mixed trends between 2023 and 2025. In 2023, the gross profit margin was 39.6%, which decreased by 16.4% in 2024 to 33.2%. However, this trend continued with a further decrease of 1% in 2025 to 31.2%. On the other hand, the net income margins saw an increase from 3.9% in 2024 to 4.7% in 2025. The fluctuations in profit margins can be attributed to various factors, including changes in total share-based compensation expense and non-cash mark-to-market adjustments. The total share-based compensation expense increased by 13% in 2025 compared to 2024, which may indicate a decrease in profit margins. However, the net income was also affected by significant non-cash mark-to-market adjustments in 2025, which could have contributed to the increase in net income despite the decrease in profit margins. The company's financial performance indicates a significant improvement in its ability to generate cash from its core operations. The operating cash flow has turned positive, reflecting the company's increased efficiency and effectiveness in managing its resources. This is evident from the net cash and cash equivalents from operating activities, which stood at $215,513 in 2025. This positive trend is consistent across multiple pages of the financial report, including page 34, page 38, page 39, and page 58, further reinforcing the company's ability to generate cash from its core operations. The generation of positive operating cash flow is a key indicator of a company's financial health and stability, suggesting that the company is well positioned to meet its short-term obligations and invest in future growth initiatives. The company's debt level has undergone significant changes over the past year. Initially, there was a net paydown of $1.2 million of total debt in 2025, indicating a reduction in debt. However, this trend was short-lived as total short-term debt increased by $150.3 million in 2025. Furthermore, the total debt level rose from $88,289 to $97,381, showing an overall increase. In terms of interest expenses, there has been a mixed trend. In 2024, interest expenses decreased by $452,000 and then further decreased by $1,442,000 in 2025. However, despite these decreases, the company's interest expenses increased from $10,409 in 2024 to $20,034 in 2025 due to a 1% increase in interest rates. The management is optimistic about the company's outlook, focusing on long-term growth and innovation in high-growth end markets. The company prioritizes research and development (R&D) to drive new products and technologies, with a goal of staying ahead in emerging trends such as connected driving, artificial intelligence, and the Internet of Things. The management is also committed to strategic acquisitions that promote business objectives, including the recent joint venture agreement with ATX to build synergies related to testing and packaging. Additionally, the company has a diversified investment portfolio with minimal concentration of risk within each asset class, which supports its financial stability. In terms of market focus, the company is targeting key areas such as automotive, industrial, computing, consumer, and communications, with specific initiatives in connected driving, electrification, and smart infrastructure. The management strategy also includes maintaining a strong research and development R&D focus to drive innovation and growth. Overall, the management's outlook is positive, driven by its commitment to innovation, strategic acquisitions, and financial stability. The company has made significant acquisitions and divestitures in recent years to expand its operations and portfolio. Acquisitions have been a key strategy for the company's growth. Notable acquisitions include Global Advanced Packaging Test Limited, Fortimedia, Inc., onsemi's wafer fabrication facility, Lite-On Semiconductor, and Texas Instruments' 200 wafer fabrication facility. These deals demonstrate the company's commitment to expanding its capabilities and increasing its market share. In addition to these major acquisitions, the company has also made strategic investments in other companies. For example, it acquired a 43% interest in ATX in May 2025 and Atlas in July 2021, with additional interests purchased in April 2023 and June 2025. The company has also formed a joint venture agreement to acquire a 43% interest in ATX Semiconductor, SDN. On the other hand, the company has also made divestitures as part of its strategy. One notable example is the sale of TF Semiconductor Solutions, Inc., for $16 million. This move suggests that the company is actively managing its portfolio and focusing on high-growth areas. Overall, the company's acquisitions and divestitures reflect its commitment to strategic growth and expansion. By carefully selecting which companies to acquire or invest in, the company can increase its market share and improve its competitive position. The company's financial strategy is multifaceted. One key aspect of this strategy is its commitment to returning value to shareholders through dividends and share buybacks. Specifically, the company has a policy of paying out up to $75 million in dividends per fiscal year, as stated on page 68 of its financial reports. In addition to dividend payments, the company has also engaged in share buyback activities. This means that it has purchased shares from the market, reducing the total number of outstanding shares and potentially increasing earnings per share for remaining shareholders. The decision to engage in share buybacks is a deliberate choice by the company's management, aimed at enhancing shareholder value. Overall, the company's approach to returning value to its shareholders reflects a focus on creating long-term value through strategic financial decisions. By paying dividends and buying back shares, the company demonstrates its commitment to supporting its investors and driving growth in the years ahead. Concerns about inventory buildup or supply chain disruption. The extracted summaries reveal several concerns regarding inventory buildup or supply chain disruption. One of the primary concerns is the risk of obsolete inventories due to changes in demand for products, pages 12-18. This can lead to a strain on management and systems, as well as increased labor costs. Another concern is the potential for production disruptions at manufacturing facilities, including natural disasters and other extraordinary events, page 11. Additionally, excess capacity in manufacturing facilities due to decreased demand could result in lower gross margins, page 14. The dependence on third-party suppliers for timely deliveries of raw materials and manufacturing services also poses a risk, page 16. Labor shortages in China may lead to future supply delays and disruptions, while increased labor costs could make doing business less advantageous, pages 22-23. Furthermore, changes in customer order levels, key supplier relationships, and inventory management can all contribute to inventory buildup or returns, pages 35-40. The data on inventory changes from 2023 to 2025 also highlights a significant increase in inventory levels, despite a decrease in net sales in Asia. Overall, these concerns highlight the need for careful management of inventory and supply chains to mitigate potential disruptions. That concludes the financial summary for Diodes Incorporated. Feel free to comment below and I will be happy to answer them when possible.